This past Wednesday afternoon, the markets had a dramatic pullback. Did you just expect equities to keep going up forever? The big question is, why did the equity and bond markets pull back on Wednesday and Thursday? About a week earlier, the Producer Price Index, or PPI report, came out a little hotter than expected at the top of the normal range, as you can see here. This purple dashed line is the top of the normal range. This other one is the bottom of the normal range. But this was a little hotter than what Wall Street expected. The markets didn't really react and in fact moved higher over the next several trading days. Then, this past Wednesday, the Federal Reserve announced they would be cutting their Fed funds rate by 0.25%, as everyone expected. That's good. But then Chairman Powell made a statement saying,
"But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts." And all of that is reflected, to your question, in the December SEP, which shows a median forecast of now 2 cuts next year compared to 4 in September.
The equity and bond markets reacted by pulling back violently, with the S&P 500 dropping almost 3%, the NASDAQ 100 dropping 3.61%, followed by another drop of minus 0.45% for a total 2-day loss of 4.04%. And TLT, the 20-year Treasury ETF, dropped 1.25% on Wednesday, followed by a more severe 1.5% drop on Thursday for a total 2-day loss of 2.75%. But then on Thursday, the Personal Consumption Expenditures, or PCE index, which by the way is the Fed's preferred measure of inflation, came in lower than expected and well within its normal range. So the S&P 500 moved higher by 1.09%, the NASDAQ 100 moved higher by 0.87%, and TLT, the ETF for 20-year Treasuries, moved higher by 0.57%. To better understand the relationship between equities, bonds, and the monthly change in the PPI and PCE indices, I created this graph going back almost 15 years. And what you can see here, this white line, is the monthly change in the PPI index. And in general, there should be 12 of these within a 1-year span, unless it stayed constant for 2 months in a row. This sort of orange line in here, this is the PCE index, and you can see that it runs in a more narrow range than the PPI index. And where are we right now with all of this? Well, you can see that the PPI is just touching the top of the normal range, but it has been declining recently. And you can see that the PCE index has really been declining and in fact is in the lower half of its normal range, as you can see here. So do you think we really have anything to be worried about? As you can see from this chart, there appears to be nothing to worry about unless inflation increases and the Fed starts raising rates, like they did back here in 2022. And you can see that equities fell and bonds fell. Right now, to me, that looks highly improbable. And I stand by my many earlier predictions that inflation will continue to come down as productivity gains continue to increase over the coming years. Did you sell equities this past week? And if you did you move that money into long-duration Treasury bonds through an ETF like TLT or EDV? Please let me know in the comments section below. With all that, let's go through the current health of the stock, bond, gold, and crypto markets. Don't wanna let you down. So if we look at how equities performed over the past week, you can see we had a fairly nice gain going on here until Chairman Powell spoke on Wednesday afternoon, and then boom, the markets just plummeted. Now they did start to recover on Friday, and it'll be interesting to see what happens next week. Over the past month, though, we have a fairly healthy looking appetite for equity risk. We've got ARK Invest up at the top, NASDAQ 100 second, S&P third, Dow fourth, and small caps are last. And we'll talk about why the small caps plummeted so much. And then if we look back over the past year, you can see that equities have really come roaring back especially from this bottom here. And ARK Invest, while it's still not ranked number one, will move higher as long as the environment for equities stays positive. But I like the fact that the NASDAQ 100 is right up here on the very top. And what do the bottom dynamics say about this? Well, you can see we have a bottom forming indicator way up here at 100%. Why? Because we had a pullback. But you can see the confidence level, while it's high, it's not high enough to confirm that this is a bottom. Now, do we have to have a bottom confirmation? No, not particularly. We haven't really had a major pullback. So I don't like the fact that as the market went up on Friday, the confidence level pulled back. That doesn't give me much confidence, but it's still up here at a fairly healthy rate. So there is a fair amount of herd behavior here. And by the way, the confidence level is this black dashed line. It basically tells you, are investors acting in kind of herd-like behavior, which tends to happen at extremes, either high points in the market or bottoms in the market. And then what about risk versus opportunity? Well, in general, I really like this. You can see that opportunity acceleration is way up here above 75. Now, it did fall a bit toward the end of the week last week, but I like the level it's at. And you can see that the opportunity level has been moving higher and is very nicely higher above 60. So this is good. And I like the fact that these are well above these. So what are these? Well, the yellow line is risk acceleration, and it's down here at 40. I mean, that's really nothing to be concerned about. Now, it did move higher at the end of last week. And then risk, the red line, which is a very laggy indicator, has been moving higher, but it's still at a very, very low level. I will not start to worry until I see these move up above 60, while simultaneously these move down below 60 or even worse, below 50. So we're in a good place right now. And what about equity versus safety? Well, I said I was going to talk about why small caps have been falling, so let's talk about that. If you look at the overlays, you can see that the NASDAQ 100 is solidly up here in first place. But what's happening here? Why did small caps go from first a few weeks ago all the way down to ninth this week? Well, you have a fear that the Fed might start raising rates. And if the Fed raises rates, small caps are going to get hurt. If rates come down, small caps are going to benefit. So this is really a reflection of Fed Chairman Powell's comments on Wednesday. And you'll notice that cash moved from 8th place all the way up into 2nd. Now, cash doesn't move. Cash is flat. It doesn't do anything. So for cash to move up, a lot of things had to push down here into the lower part of the graph to float cash up to 2nd place. What caused that? Well, if we look at safe haven assets, you can see that gold fell down. You can see that TLT really collapsed. You can see that EDV, longest duration treasuries, went from 2nd all the way to last because of the fear that the Fed might start raising rates. So all of these longer duration or riskier safe haven assets plummeted in the rankings, causing cash to move up. Now, intermediate treasuries moved up and short duration treasuries moved up the most. So this is clearly a flight to safety. Short duration treasuries are much safer than EDV, which are the longest duration treasuries here. And how does this show up in the buying and selling pressure? Well, you can see, in fact, I think I talked about this last week when the selling pressure was up here for the Dow, that it was likely going to turn at some point and head south. Well, before it did that, it went a whole lot higher. And usually selling pressures up here above 8 are not sustainable. And you can see what happened. The Dow bottomed out, selling pressure absolutely collapsed, and the buying pressure is starting to come up. Hopefully this bodes well going into next week. And if we look at the S&P 500, not as dramatic, but a similar picture here. And the NASDAQ 100, not nearly as big of a spike in selling pressure. And then if we look at small caps, we had somewhat of a spike here in selling pressure. But again, it's backing off and buying pressure is moving higher. And how does this look for ARK Innovation. Well, if we take a look at ARK Innovation, you can see we had a fairly healthy peak here in the selling pressure, which then plummeted as it turned around and started moving higher. And how does sector rankings look? Well, to me, these move slowly. These kind of integrate over a longer period. So these are not going to move quickly. And you look, even after all the gyrations last week, we still have a fairly healthy situation here with Bitcoin and ARK Innovation ranked right up here in number 1 and number 2 spots this week. Consumer discretionary third. We've got the NASDAQ 100 up here. Emerging companies. These are riskier assets, and they're all up here at the top, and cash and gold are down here along with treasuries. So this looks very healthy. Now, consumer staples did move up a notch, but nothing to be concerned about. Now let's take a look at sector rank acceleration, because these move more quickly. And you can see this week we still have technology sectors ranked number 1 and number 2, followed by clean energy, which is an up-and-coming technology and is needed to supply power to the artificial intelligence data centers. So what's to like here? Well, a fair amount. We already talked about the NASDAQ 100 being up here. Technology and clean energy moved up. S&P 500 moved up. That's great. Cash and gold both moved down. That's good. Consumer staples and the Dow moved up. Now, these are brown because they're both good and bad. They're equities, but they're safer equities. So in this case, I kind of don't like the fact that they're moving up. And then what looks not so good? Well, quite a bit. You've got the smaller companies in the NASDAQ 100, QQQJ, moving way down here. You've got small caps that we talked about moving all the way from way up here all the way down to right near the bottom. That's really a dramatic move. You've got the semiconductor index moving down. You've got intermediate treasuries moving up, which is a flight to safety. You've got consumer discretionary moving down, not good. You've got emerging markets moving down, and ARK Innovation moved down, and Bitcoin also moved down. So there's a lot of negativity, but all of this happened over the last couple of days of the week. And if you compare this to last week looked very positive. Now, is this anything to worry about? Well, we'll have to wait and see. Don't know. If this persists, yeah. If this cleans up next week, then it was just a big nothing. And what about treasuries? Well, just like equities, you can see they absolutely got trashed on Wednesday after Fed Chairman Powell spoke. And then they came back into Friday and sold off a little bit toward the end of Friday. So this looks encouraging. What about over the past month? Well, very nice rally, and you can see where we are. So this does not look like a healthy appetite for treasuries, but this may be a good time to buy them while they're down like this. In fact, speaking of that, let's take a look over the past year, and you can see we're right down here near the previous low. We're still above it, but we're near it. So, if I'm going to be contrarian, I'm going to be buying these here. And if you go back and look over 5 years, we're way under where we were 5 years ago. And by the way, as these fall, the yields on these treasuries goes higher. So you're getting a higher dividend payment every month in the case of these ETFs than you would have back here. And that dividend kind of helps put a floor on how far these will go down, because as the dividend gets juicier, investors are going to flock into these and start buying them, causing the price to move higher. So how does this show up in the buying and selling pressure? Well, you can see there's a collapse right across the board from short duration to intermediate to 7 to 10 year treasuries to 20-year bonds. All of the prices collapsed and then started to recover on Friday. And you can see the selling pressure went up in every case. In this case, it's up here in that range where it's not sustainable. And in the case of 20 years, it's even higher than that. This is not sustainable. So hopefully, going forward, the prices on these move higher as this corrects itself and the buying pressure starts to recover, as it started doing on Friday in every single case here. And what about the yield curve? Well, let's take a look. Well, now, because the Fed lowered rates, remember I said when the Fed lowers rates, the rates at the low end will come down very quickly, which is exactly what happened. You can see that here. And the yield spread, which indicates if we're inverted or not inverted, is showing we're currently not inverted at 24.55 basis points. So this is improving. This was much closer to zero over the past several weeks. But you can see this dark blue line, the yields at the 10-year and 20-year range have moved up, and at the 7-year. So at the longer end, yields have moved up. At the shorter end, where the Fed controls things, they have moved down. So what do the markets think the Fed's going to do in 5 weeks when they meet? Well, given Chairman Powell's comments, they firmly believe that the Fed's not going to lower rates in January when they meet. Now, there's no way to tell this. There's other data that's going to come out between now and then, and the Fed could change their mind. What about in March? Well, in March, you can see there's still more than a 50% likelihood that the Fed's not going to lower rates. Now, do I believe these? No, I don't. There's a lot of data that's going to come out between now and March, and these could change drastically by then. And then if you get out to April, then there's a little bit of a nod to the fact, well, the Fed might lower by 0.25% by then. But I think these are going to change a lot between now and April. And we'll just have to revisit these and see how this moves along as we get into January, February, March, and April. And what about gold? Well, if you guys have been watching my videos for any length of time, you'll know I'm not a fan of gold. It's really tough to make money in it. It doesn't pay a dividend. I know it's kind of like Bitcoin in that way, but there's nothing to drive this higher except demand and fear. And right now, this is saying there's neither. So the price has been generally declining over the last 2 months. More recently, it's been declining again. And you can see that the selling pressure moved up here. Now, it fell off on Friday as gold recovered and the buying pressure started to increase. But I don't see much opportunity here. What about Bitcoin? Well, Bitcoin's been kind of struggling as of late. You can see that it moved up very nicely. And then just like equities and other risk assets, it really pulled back on Wednesday and Thursday and then started to recover a little bit on Friday. And you can see that the buying pressure was dropping as the price was moving higher. That's a divergence. That usually can't last. And in fact, it didn't. Now, we'll have to see what happens going forward, whether these continue their rally or they take a breather for a while. As you can see from the price movements and metrics, the equity markets and Treasuries are looking weaker than last week from the shock of the 2-day drops on Wednesday and Thursday. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next time, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.